Guess what psychologically happens to us when we buy a stock and the price goes down? It's something that keeps us poor. It's amazing if you think of the psychology of it. The psychology is very simple.
Yeah. Hey, Lauren, I got a question for you.
What?
What's your take on the coronavirus?
Scary. I don't like it.
And would you be investing in a time like this?
Yeah.
Why?
I think take advantage of people's fears and things are priced lower, and that's an opportunity for you to invest while it's low.
Hey everyone, Kevin here, and I've got 5 rules that I want to share with you that relate to what's going on regarding the coronavirus, but also happen to help us understand why it is that rich investors make so much more money than poor people who maybe dabble in stocks. And my goal is to make it so that all of you can follow the rules of the rich investor. So today I want to break down these 5 rules in a very simple format, so hopefully we can all make a lot of money together and then go to Vegas together. So I was at a house party in Vegas the other night, and one of the things that I reacted with when talk came up of the coronavirus was, hey, the coronavirus is not something that's fundamentally changing the companies that I'm investing in. This is really important because, yes, the coronavirus is going to have an impact on production lines at Apple, at Tesla. Of course, the coronavirus is going to have an impact on travel companies, whether you're investing in cruise lines like those sweet dividend stocks that Carnival gives you. And I think we're going to see broader economic damage in terms of, lower GDP. We're going to see lower revenues. We're going to see lower profits at companies. And earnings reports in the future are going to be weaker than expectations. In other words, even if the coronavirus disappears in 3 months and in 6 months and in 9 months, all of the next earnings reports that come out are probably going to see dents in their earnings because of the impact the coronavirus is having. But to me, the coronavirus doesn't fundamentally change the long-term success of the companies I'm investing in. In fact, Warren Buffett reiterated this exact belief and reaction that I had this morning. I'm going to go ahead and play that clip of Warren Buffett in just a moment, but my long-term belief is always invest in quality companies that I believe in. I do the same thing when I invest in real estate. I don't speculate on this is an up-and-coming area. I don't go invest in Texas and Florida because I think the cash flow is better there. I don't know those areas, and I don't invest in companies or products I don't know. So I invest where I believe there's quality. So I invest in really good neighborhoods. I invest in what I believe are really good companies. And by following this investing mindset, I can do exactly what Warren Buffett said to do, which is to always focus on what are these companies going to be doing, not in the next 3 months, 6 months, 9 months, but what are they going to be doing over the next 20 years? And that is where I like to place my money. Here's Warren Buffett.
Now coronavirus is front and center. Something else will be front and center 6 months from now, and a year from now, and 2 years from now. The real question is where are these businesses going to be 5 and 10 and 20 years from now? Some of them will do sensationally, some of them will disappear, and overall, I think America will do very well. It has since 1776.
See, to me, larger shocks to the overall market don't tell me that I'm making a mistake with an individual company. Just because one of the stocks that I'm investing in drops 5% the day after I buy some of the shares doesn't mean I've made a mistake, even though it feels like I've made a mistake. More on that and psychology later in this video. Stay tuned. Let's think for a moment, what happened over the last 18 months in the United States? Well, we've had a lot of this belief that a bubble is coming. Yet in reality, what happened in 2018 was, as the Trump tax plan overhauled the tax system, we actually saw a shock to the stock market and the real estate market, and we saw all of these potential products, potential investments decline in value somewhere between 10 to 15%. Certainly, the summer of 2018 was a pretty red summer for real estate, and the winter of 2018 was a pretty red winter for stocks, which made the beginning of 2019 a very opportune time to buy real estate, which also happened to be the time that I was walking through a mall in Aventura, Florida, filming my opinions about how everything was now on sale because we've seen such a long extended period of red, which I stuck with that belief, and since since the beginning of 2019, I've purchased 6 properties in Southern California. These aren't $10,000 houses. They're all like $400,000 to $700,000 houses. And that's because when I make a video sharing my beliefs with you, I also put my money where my mouth is. But what's interesting is, well, we were all so nervous about a bubble or a recession coming, we partially missed a really big buying opportunity at the beginning of 2019 because of the shock that happened in 2018. There was sort of this fear that, okay, well, if there's a shock in 2018, things are going to be even worse in 2019. When in reality, a lot of steam has just been sort of removed from the bubble. Like, any bubble that there was just reduced by a good amount. Well, the same thing might be true now. The more red days we see now, the more inexpensive things might be in the next few days and weeks. But the problem with this is the belief that when this oftentimes happens, we think to ourselves, oh, well, wait for the big crash. Wait for the big recession to come. And that's where I take a position of, don't wait. Never wait. If there's a red day, buy. Execute some trades. Even if that means tomorrow's cheaper, then execute some more trades tomorrow. I've indoctrinated myself with that belief because I saw what happened in 2010 and 2011 when we look back, we go, well, yeah, come on, Kevin, 2010, 11, that's when real estate prices were rock bottom. Anybody could have invested in any stock and made money. Exactly. Because when we look back at 2010 and 2011, most of the time, people who were not investing were saying, I don't want to invest because I think there's going to be a double dip recession. I think things are going to crash more, things are going to crash worse. So when I see red days like today is Monday, February 24th, which I cannot believe February is almost already over. I look at red days like today and I say, I'm executing trades.
So do you want the 10 or the 20?
Both.
And that's because, tip number 3, I'm not interested in posting to Reddit to show off how successful my options or my trades are. Now, I'm not trying to bag on anybody who does options or short-term trading. It's totally fine. If you find enjoyment in that, you find it profitable, do it. Options can be a great way to make a lot of money fast. It's just not congruent with my investing belief, which my investing belief is, don't sell. It's kind of like when Tesla has a red day, I buy more shares. I don't sell to lock in profits, because what happens when you lock in profits? You just give a share of your profits to the government. I'm not interested in giving 40 to 50% to the government in short-term taxes. I also have nothing to prove. I'm not interested in selling to prove that I've locked in gains. To me, locking in gains is a saying that's perpetuated by the stock industry. That is like the brokerage industry, which encourages you to sell to lock in profits, when in reality it's to make fees. And even when we think of, well, come on now, so many companies have commission-free trading, sure, but don't worry, thanks to high-frequency trading, any company, even Robinhood, makes a lot of profit off every single trade you make. The Wall Street Journal has repeatedly studied this, and it's really a boring and niche topic to go into in this video, so I won't. But the point of my tip number 3 is I don't need the money that I'm investing within the next 5 years. And my rule of thumb to you, for you to consider, is if you need your money within the next 5 years, you probably want to be careful when it comes to shocks like this, tax overhauls, the coronavirus. But if you're investing for the long term, you're investing for the next 10, 15, 20, 30 years, then to me, today's price doesn't matter. The only thing that matters is the quantity of ownership that you have. How many Apple stocks do I have? What about Starbucks stocks, Target stocks, some of the favorite companies that I invest in? What about Disney stocks? How many shares of these companies do I own? Well, just because I own 523 shares of Tesla doesn't mean I care if the price goes down or the price goes up. In fact, I tend to have a very opposite belief when it comes to stock market movements. When I see the price go up, I get sad because it means I can't continue to take commission checks that I make from real estate, take those and throw them into more buying opportunities of Tesla at cheaper prices. I like red days because I'm looking at companies that I invest in over the long run. So rule number 4 has to do with understanding the psychology of focusing on price. That's pretty cool. Look at that. Old caddy. That's awesome. See, what I like to think of is, I think of tennis. If you play tennis and... Hello. When I think of investing in stocks, I think a lot about tennis. That is, if I swing the tennis racket, I swing my forehand, and I miss, I start thinking to myself, ooh, that sucks. I need to improve my swing. And these little brain synapses connect in my head that say, okay, the way I swung the racket there was bad. With tennis, though, because I like tennis, I continue to swing the racket. With stocks, though, guess what psychologically happens to us when we buy a stock and the price goes down? It's something that keeps us poor. It's amazing if you think of the psychology of it. The psychology is very simple. Much like in tennis, when you swing the racket and you miss, your brain programs you not to swing the racket like that. So what happens when you buy a stock and then the price turns red? You program yourself, A, not to buy stocks, and B, to stay away from red. Which means A, you're not investing, or B, you're not investing on red days, which are the days you should be investing on. See, a lot of you who are in my real estate investing course, or my finance course, or even my management course, y'all know that I look at investing of any kind from a psychological point of view. How can I psychologically trick myself to make more money? How can I psychologically beat other agents? How can I psychologically prevent evictions? Like, how can I use the tools of my brain and other people's brains to make money? And this is a very big lesson when it comes to stocks. It's understanding that, wait a minute, oh my gosh, that's right. If I execute a trade and then every day I neurotically look and see what the price is, I'm programming myself to do the opposite of what I should be doing. And this is why my biggest rule of thumb is always focus on quality and quantity. Never focus on price. That is, try to prevent yourself from relying on the price to let you know if you made the right decision in the short term. Checking the stock price the day after or the week after you bought a stock and then feeling bad or feeling great is a bad way to train your mind how to be a rich investor. That is, I don't care if some crappy stock is having a run-up. If it's not quality, I'm not buying it. I want my quantity, and then I say, talk to me in 20 years. Might not make for the most juicy Reddit post, because if I post in 20 years, look at all the money I made in stocks, people are just gonna go, well, anybody made money if you just invested 20 years ago. Exactly. That's why I say, talk to me in 20 years. You can't really go wrong usually as long as you're buying quality companies. Careful how you're walking with them, okay? Hold them like a scissor, the other way. Hold the tips. There you go. Good job, Jack. Now, before I get to number 5, I will say it's probably a good idea for you to stock up on some respirators. You know, you could get the N95s. I personally prefer the real stuff. These are the P100s.
You know, you gotta attach them correctly, and you know, I'm not gonna do that right now, but the cool thing about these is you can test them. See, if I can breathe in, it means the seal's not right.
And that's actually what I really like about respirators like this, is if you can test them to make sure the seal's good. That is, when you hold them down and you can't breathe, because you're covering up the filter, it means there's no chance of any air coming through the side. So I personally like P100 respirators. Now, number 5, let's talk impacts here, like practical impacts on real estate and stocks. Real estate is probably going to do surprisingly well throughout a situation like this. Even though fears in the stock market create temporary issues, I use fears in the stock market to psychologically beat up sellers when I'm making offers. On top of that, and this is blowing my mind, but interest rates are actually falling, which when interest rates in real estate go down, prices usually go up. To me, that actually creates more insulation and protection for me for the stuff that I already bought and the stuff that I'm negotiating buying, because I'm able to negotiate lower prices with fearful sellers and I'm able to get cheaper loans. I increase my protection even more. So some of the principles we talk about in the investing group. In terms of stocks, I love volatility because every single time stocks go down, I buy. every single time. I love red days. It's one of my favorite rules.
This is where the batteries are, Jack.
Thank you.
As far as stocks and companies themselves, obviously we can expect cruise lines, companies like Disney and Tesla and Nike all to get hammered. Which in my opinion, because I'm personally not expecting a big recession or a big bubble or anything crazy happening over the next 4 years, although it's possible that could happen, I think the more red days we see now, the lower likelihood of any kind of big recession or crash happening actually is. That is, think about it. If we have a bubble right now, any coronavirus fears that actually hurt the market, all they do is kind of deflate that bubble for us, which means there's more time between now and potential bubble burst recession. I don't believe a slow leaking bubble all of a sudden bursts. You know, I think a rapidly expanding bubble bursts like what we saw in 2007, 2008. But this slow leak that the coronavirus is causing, to me, it's all the more reason to continue to throw money at the market. I know some of you might think, hey, Kevin, you're crazy. And you know what? Maybe I just am crazy. But a lot of you have been asking about my opinions on the market, what's happening, what's going on, and know that I watch the fundamentals every single day. I get every paper there is, the USA Today, the New York Times, the Wall Street Journal, the LA Times, the Financial Times, the Economist, and more. I read a lot. I love reading a lot. But I'm not going to regurgitate a bunch of charts to you and try to prophesize to you. Instead, I want this video really to be about, hey, this is my strategy, these are the principles that help guide my investments, and hopefully they can help you make some money as well. Thanks so much for watching. Follow me on Instagram, and until next time.